U.S. banks are still not out of the woods, and profit gains will be offset by future losses on loans and investments. So, after more than a year of bruising financial turmoil, U.S. banks have some good news to report. Profits have been surprisingly strong for the first quarter of the year. Well, of course, many U.S. banks have received billions of dollars of taxpayer money, so they should make at least a little bit of money. Beyond those headlines, though, the outlook is still tough, with huge piles of bad assets remaining and a weak economy ahead. Yes, jobs are still being lost. The banking industry is still a long way from regaining a solid footing. The latest news came from Citigroup, which reported its smallest quarterly loss since 2007 on Friday, and had better than expected results overall. And banks haven't been shy about getting the good news out. Last week, Wells Fargo said it expected to post a profit for the latest quarter. The bank said loan losses would be far lower than Wall Street economists had been expecting. And investors have responded accordingly. In the past week, shares of Citigroup, J.P. Morgan, Bank of America, and Wells Fargo have surged, and broad stock market indexes are at their highest levels since early February. But the good news is not all good. The biggest one, although the revenue coming in the door may be higher than the cost of doing business, the banking industry still has a gigantic mess to clean up from the misguided lending spree that produced trillions of dollars of losses and bad loans. Yes, once again, this is still about greed. Pure greed has created all these problems. But the U.S. banks are still having to deal with. It's not over yet. Despite the industry's huge pile of shaky loans, it's no mystery why many banks are making cash hand over fist. Since the financial panic began last fall, the Federal Reserve has been leaning heavily on interest rates, pushing the bank industry's borrowing costs down to nearly zero. So then, if you're a banker lending that free money back to customers for, say, 5%, it's pretty hard not to make money. The Fed's hope is that banks can generate cash quickly enough to fill the multi-trillion-dollar hole in their books created by the meltdown of the housing market and the recession. So as long as the Fed keeps interest rates near zero, banks should continue to generate fresh cash, theoretically. But as that money comes in one door, it's flowing out another as the slump in business activity and rise in unemployment pushes more borrowers into default. It has become a vicious cycle. Certainly on the commercial and credit card loan portfolios, we're seeing credit quality continue to deteriorate there, said one economist. While banks are hauling in cash on the loans they're making, their return to the black won't help get the economy moving again until the overall volume of loans begins expanding theoretically. And the U.S. banks, they're not all of the economy. They're only part of it. Consumer spending drives approximately 2/3 of the economy. If consumers don't have jobs or they're not spending their money, then there'll be no recovery. Period. Anyway, so the news on that front, has not been promising this week. The Treasury's latest monthly tally of lending from the nation's biggest banks showed 9 reported increases and 12 posted declines. The median, or midpoint, for lending activity fell 2.2% in February, and new construction of homes has also fallen in March. The sharp drop in mortgage rates has boosted lending in that category by 35.4%. Home equity lines of credit were up 17.7%, but lending to businesses plunged 47%. And when they stand up, they're always falling backwards. Not able to go forward, never able to progress. It's at all not clear just how much more money banks will lose from the hundreds and hundreds of billions of dollars worth of loans and investments backed by real estate and other consumer loans that may yet default. Although home prices or home sales have perked up a bit, the prices are still falling. Despite the government's recent efforts to halt home foreclosures, the pace has recently picked up again. Earlier this year, most lenders put a halt to foreclosures until the details of the government plan were worked out. Now that those halts have expired, lenders have picked up the pace of foreclosures on households that aren't good candidates for loan modification or refinancing. So then, as a result, a number of households facing foreclosure grew at least 24% in the first 3 months of this year. Nearly 804,000 homes got at least one foreclosure-related notice from January through March, up from approximately 650,000 in the same time period a year earlier, according to Realty Track Incorporated, a foreclosure listing firm. So, in essence, in reality, the economy is still getting worse, no matter what the banks say. It's tough for banks to forecast how many more defaults are coming, but there will be more. In the early stages of the housing meltdown, many borrowers fell behind because they faced big jumps in payments from adjustable mortgages, which are relatively easy to modify to more affordable terms. And more recently, mortgage defaults have been driven by rising unemployment, rapidly rising unemployment. It's much harder to provide foreclosure relief for borrowers who lose their income. And lenders also face a looming problem with bad loans on commercial real estate. Many of those properties were financed with loans that come due in the next few years. Refinancing those loans is tougher as credit standards have been tightened, and commercial property owners are also getting hit by the recession. So, again, the economy is still in a recession or depression, or whatever have you call it. No jobs, no recovery. It's quite simple. And all these things are connected to something bigger going on around the world every day. And these are more signs of the end times transition days. And the transition is still going on all around the world, day by day.